Evening, everybody. I'm Nathan Troran. I'm a tax partner at Zeifmans. And my session is going to be a little lighter, talking more about a perspective on what's been going on in Canada over the last number of years and where we stand on an international scale. So the first thing I thought I would just present is about since a lot of the people attending are Canadians, what's been going on in terms of personal taxation in this country since 2008. I chose 2008 because relative to 2018, 10 is a nice even number. But if you remember going back in time, 2008 was a pretty scary time. It was the advent of the subprime mortgage crisis, and things looked like everything was falling to pieces on an international business scale. As we could see, relative to 2008, where we are today, taxation has gone up significantly. In terms of rates, it's today the top marginal rate in Canada on things like salary and interest is 53.5% versus 46%. On dividends, this differential is about 16% on eligible dividends and 15% on ineligible. And capital gains, not that different, only because 50% of a capital gain is taxable in Canada. We've also had the elimination of many personal tax credits. Most importantly, though, in terms of taxation is for business owners, is the fact that there's been recent amendments to what was formerly called the kiddie tax. And now they've imposed it not only on minors, but on adults as well. And what it's going to result in is considerable hardship for business owners in the sense that they used to be able to pass on dividend income to their children, to their spouses, and you would benefit from the graduated rates, but no longer unless you happen to be actively involved in the business or you meet certain other conditions. And as a result, the lost tax benefit could be as much as $35,000, but not being able to split income with your family members. Now that being said, there is some good news still, and that is the fact that capital gains, as I mentioned, is still only 50% taxable. So that presents an interesting opportunities. As you may have noted before, there's a big divergence between the taxation personally of capital gains relative to dividends. It's as high as 20 basis points. So if possible, one of the ways to tax plan is to try to do a transaction whereby a business owner realizes a capital gain rather than receiving their remuneration through dividends. This type of tax planning is on the radar screen of the Department of Finance. In fact, they tried to curtail it back in July of 2017 with the whole rash of proposed amendments that they had, but since then they've scrapped it, and so for now at least this seems to be still valid tax planning. The other thing that seems to be very much entrenched in the Canadian tax system, and which is really the biggest tax break personally to owner-managers, is the lifetime capital gains deduction. What that is for most owner-managers, rather than there is a break for farmers and fishermen, but for regular business owners, when you sell shares that are what's classified as qualified small business shares, you could realize up to now $850,000 of the realized capital gain on a tax-free basis. And so this is a very attractive proposition as an exit strategy for most business owners. The thing that was often done is that you would try to structure the ownership through either direct ownership by family members or alternatively through a family trust, and try to sprinkle the capital gains deduction not only to the business owner but amongst family members as well, and therefore multiplying the benefit derived from selling the shares. That type of planning is still valid tax planning. It was also tried to be curtailed by the Department of Finance back in mid-July of 2017, and those proposals were also abandoned. And what's also notable is the fact that although these kiddie tax rules try to also attract taxation, the highest rates on capital gains, these rules don't apply to qualified small business shares. So this is very much still a very meaningful tax break to business owners in Canada on a personal level. From a corporate standpoint, there's good news, and that is for Canadian-controlled private companies, the tax rates are declining. It wasn't high to begin with. Federally, it was only 11%, but then they announced that it was going to go down to 10% in 2018 and 9% in 2019. Beyond that, many of the provinces also have very attractive tax rates for Canadian-controlled private companies. For instance, Ontario, the tax rate is 3.5% versus 11.5%. Now that is only on the first $500,000 of business income earned in the year. Beyond that, then the higher rates of tax applies. And beyond that, you have to share the small business rate among associated companies. So again, this is good news for Canadian-controlled private companies. However, the old adage, what the government gives, the government likes to take away. And so there's also a mixture of bad news for CCPCs. Essentially, since the Liberal government has come into power, they've had 3 budgets, and in each budget there has been an attack on the small business deduction. In their first budget in 2016, they introduced rules that prevents the multiplication of the small business deduction by paying fees to unassociated companies. That was often a very effective tax planning measure. That has been curtailed. In 2017, they legislated the fact that if somebody exercised not voting control, but what they call de facto control in fact over a company, then they can associate it. And now they've legislated that you have to consider not only exercising influence over the board, but also operational factors as well. And then finally, in the 2018 budget, they introduced a new measure to claw back the small business deduction, and this will have very real serious repercussions. Effectively, what happens is that if you earn investment income in a company of $50,000 or more, what it will do is eventually erode on a 5-to-1 basis your business limit in the following taxation year. So the government is trying to attack the ability of companies to defer paying tax by earning investment income rather than through the company, rather than having it paid out to the shareholders, paying dividend level tax and collecting their fair share of tax. Okay. So now just moving along to on the international scale. Of course, every government is grappling with how they're going to deal with various offshore income and how to collect their fair share of tax. And this has become a big deal in the wake of the UBS banking scandal and the Panama Papers leak. And so the government the CRA has implemented no less than 6 measures that I've noticed over the last few years. The most interesting was that in 2013, in the federal budget, they announced that they were going to have a whistleblower program. And that's novel because before that, Canada has never paid money to people to snitch on others. Typically it was always, disgruntled couples that are going through a divorce that they would call the snitch line and, they'd find out information that way. But now they're actually enticing people that if they have information that leads to a reassessment of $100,000 or more, that they could get a commission of 15%. They also now require financial institutions to report electronic fund transfers of $10,000 or more to the CRA. So that's another thing. They formed a committee to provide them advice on how to deal with offshore compliance. In 2017, they implemented the common reporting standards for the exchange of financial account information. There's now also country-by-country reporting, and this is going to be a big thing certainly for large corporations that have gross revenue at least 750 million euros. And the reason for this country-by-country reporting is to have some sort of consistency and transparency between countries in terms of their transfer pricing. And the sharing of this information is going to commence in 2018. And finally, there was legislation just recently introduced in order to provide a means for Canada to implement the various recommendations under the so-called BEPS project that came about under the OECD G20 project. On a practical level then, what does these international measures mean for somebody like me as an accountant? So first of all, I've been seeing a wave of letters where, because of the CRA is being informed of this transactions, electronic fund transactions of $10,000 or more, they're now sending letters to people that they're advised about that had something, it's a soft letter, and basically they're saying, well, we're aware that you had a transaction of, $10,000 or more, and, you're obligated to report your income and stuff like that, and we have a line to help you out if you need it, et cetera, et cetera. So, but they are, it's a soft letter, but, it kind of makes you worried when you get one of these things for sure. Another thing I've seen on a practical level is that the CRA is now really cracking down on foreign tax credits in Canadian returns. So typically when you make a claim, let's say you have a Canadian that has a rental property in the United States, pays tax on the rental income, files a Canadian return, claims a credit for the US tax paid. Well, the United States, the CRA, in the past they would have accepted the tax return. And you submit it and they'd say, okay, fine, that's fine. Now, nope, they want the transcripts from the IRS to confirm that you actually paid the tax. It's not just a matter of giving them the tax return. And of course, there's problems because often we file our tax returns before the Americans because Americans like to extend their tax returns, and that's part of the system in the United States. So try to get a transcript for a tax return that has yet to be filed. Not so easy. But nonetheless, this is one of these practical issues that I'm seeing a lot of in terms of because of the CRA's enforcement in the international area. The last thing that on a practical level I've been seeing is the fact that now they've cracked down on the voluntary disclosure system in Canada, which was a very effective tool to come forward in order to rectify problems, not just on an international scale, but often the kinds of issues that I got involved in is on an international scale where there was undisclosed income, lack of foreign reporting, and so on. And as a result of cracking down, now because they perceived that there was abuses of the system, they now have two programs. One in which it's much the same as the before, where they would absolve you of any penalties and they give you interest relief as long as you paid the taxes. But now they have this new program called the limited program where they basically say, sorry, we're not giving you any of that kind of relief. The only thing we're going to agree to do is not criminally prosecute you. So it remains to be seen how you're going to be able to rectify these problems. To me, it was a very good tool to rely on to come forward. Unfortunately, that's not the case anymore. Okay. All right. So the last thing I just want to talk about in terms of Canada is what does tax reform mean on a global perspective for Canada, US tax reform? Because this is our neighbor to the south. It's obviously a much larger economy than Canada has. And so what does it really spell out? So prior to US tax reform, Canada had a huge advantage from a corporate taxation point of view. The tax rates in the United States was 34, 35%. There was a graduated system, but it got clawed back very quickly. Whereas in Canada, the federal rate was 15%. So it was not untypical to see Americans that are doing business in Canada to want to, leave the, earnings here, just redeploy it in Canada and so on because of the deferral aspect of earning income in Canada. That now has changed radically because under US tax reform, the federal corporate tax rate is now 21%. So that advantage of almost 20 basis points is now eroded to 6%. And in fact, it's actually less than 6% because under the federal rules, they permit a deduction for state taxes paid, whereas in Canada, the federal government does not provide a deduction for provincial taxes paid. So when you factor that in fact, the discrepancy is even less than 6%. That said, right now, on a basis of federal taxation, still advantage Canada. Where the real discrepancy lies, though, is at the level of the states versus the provinces. So just by comparison, the tax rates on non-CCPC income ranges provincially from 11.5% in Ontario and Northwest Territories to 16% in Nova Scotia and PEI. When you compare it, though, to the United States state tax rates, there is an enormous differential that favors the United States states. So, for example, I cite Florida, California, New York State, Illinois. All of these states have much lower rates of taxation. There are some states that don't really impose tax on income. They impose tax on annual sales, such as Ohio. Texas imposes a franchise tax. And in fact, there's 2 US states that don't even impose corporate income tax. That's South Dakota and Wyoming. So when you factor this in, advantage United States. Now, to me, what might be the tipping point beyond the foregoing is the fact that now under US tax reform, they've offered really generous write-offs of capital additions. So prior to US tax reform, there was bonus depreciation that was limited to 50% of the cost of eligible new property. Now they've, under their tax reform system, they've modified it. It's now the write-off's 100% of eligible property that's placed in service between 2017 and 2022. There is going to be a phase out of 20% between 2023 and 2027. The interesting thing is that the equipment, and probably maybe Jim is going to be speaking about it, doesn't even have to be new equipment. It could even be used equipment, and it still could qualify for the bonus depreciation rates. Unfortunately, Canada's system is not nearly as generous as the United States in this area. So I've provided a slide which summarizes what the depreciation rates are in Canada. And as you can see, computer software is pretty good. Computer hardware, not bad. M&P equipment, okay. But the other ones are not nearly as generous. And the other thing is that we're on a declining balance basis, so you never really write it off quickly. It kind of takes a long time till it gets fully written off. So unfortunately, I wish I could be a little more bullish, but the reality is that by my measuring stick, the United States has 2-to-1 advantage over Canada from a taxation point of view, at least looking at it on a global scale. And coupled with the fact that we're having difficulty in negotiating NAFTA, it's clear that, to me, that this is going to be a real challenge for Canada in terms of attracting foreign investment from abroad relative to the United States if a foreign company wants to relocate or expand into North America. Unfortunately, the 2018 federal budget kind of glossed over this area, didn't really address this in a meaningful way, neither did the Ontario budget. I'm hoping that, that this is something that they will seriously look at, because clearly something has to change if we want to stay competitive with the United States. Thank you for listening. Do we take questions now? Is there any questions? Yes. How do I see cryptocurrencies affecting the Canada-US issue? Oh, so you're talking in the okay. So I mean, my area of expertise isn't in international, transactions, but I would think that this is a major problem for every collection agency. How do you monitor cryptocurrencies? It's one of these areas that I was listening to somebody that just last week that it's very easy to do money laundering using cryptocurrencies. So this is going to be a challenge, and how it's going to be dealt with, well, I'm not really sure, but my understanding is they have to, deal with getting information from the dealers themselves as to who's dealing in the cryptocurrencies to have some sort of inkling as to where to, chase the money.
We have similar rules in the U.S. about transfers of more than $10,000 of currency, but so far in the United States, we don't think cryptocurrency is currency. We think it's property. So there's no obligation to report a transfer of more than $10,000 of cryptocurrency.
But didn't Coinbase disclose all that to the IRS?
Not voluntarily. But the IRS is asking Coinbase and other operators to make disclosures of that, because they're aware that there are gaps in the matching programs between, the banking law. It's not even a tax law in the U.S. at least. It's a banking law that requires a transfer of more than $10,000 of currency to be reported. So they recognize that there are gaps, particularly with respect to cryptocurrency, and they're looking at different ways to close those gaps to, enforce the law.
Any other questions?
Good luck. Yeah, exactly.
Okay. Thank you very much.